Okay, tax students, this is the last video for Chapter 2, Part 8, dealing with miscellaneous types of income. So let's look at our 1040 form one more time. And we've already seen wage income being reported in line 1, interest income reported in line 2, dividends in line 3. We'll look at IRA retirement income and deductions in a future chapter this semester. We've seen employer pension, retirement plans, and also annuities being calculated here in this chapter. We've talked about the calculation of taxable Social Security benefits. We've seen also capital gain distributions being checked off here. And we'll deal with capital gains and losses probably in a future chapter later on in the semester. Now, if you don't see the type of income you want to report here on the 1040 form, you probably first have to report it on a schedule number 1 and subtotal it on that schedule and rewrite the total over here in line 8. So let's take a look at schedule number 1, here called additional income. That's part 1. And adjustments, remember those are deductions to arrive at AGI. That's listed down here in part 2. And this subtotal and this subtotal are then put back on the 1040 form. But let's go through the list of this additional income items. So the first one is called state income taxes that have been refunded to the taxpayer. Most taxpayers, when they get a state refund, it's not taxable. But if in the previous year, like this is 2020, if in the previous year, 2019, the taxpayer had claimed itemized deductions and subtracted out state income taxes, but then they get back a refund here in the subsequent year, 2020, that refund is going to be taxable. So let me make it hopefully a little more clear by illustrating this out. So we have the year 2020, and we go through our tax return, in this case here, the tax formula. That's the income minusing out the deductions. One of the deductions we learned was the standard deduction or an option, and we'll cover this more in detail later on in a future chapter. We can claim the itemized deductions. We want to deduct the larger of the two to save us taxes. For most people, the standard deduction is larger. But if the itemized deductions are larger, we're going to deduct here in one of the items the state income taxes that were paid during 2020. Yeah, income taxes. And we go down to figure out our taxable income. Remember, we looked this number up on the tax table or tax rate schedule to get the tax liability for the year. Tax liability. Okay, so we get a benefit by subtracting out the state income taxes we paid during 2020, which probably also includes the state income taxes withheld from their paychecks as a withholding. Now, if the state income taxes are going to be refunded next year when they file their state tax return here in 2021, that refund is going to be taxable as income. Yeah, this refund here. The reason why is because they got a benefit of subtracting it as an itemized deduction. Now, let's say that the taxpayer doesn't itemize, okay? You're not going to deduct state income taxes. They're going to deduct the standard deduction because it's larger. But still, when they file their state tax return and they get back a refund in the next year, that refund is not taxable income anymore because they didn't get a benefit of claiming an itemized deduction. Okay, so you see the difference here? Most people claim standard deduction and don't deduct itemized deductions, including state income tax. So when they get a refund of the state income tax the following year, there's no benefit of deduction, so there's no taxable refund. But if they did claim itemized deductions, they got a benefit by deducting state income taxes. And when part of that state income taxes refund, it's going to be taxable income. So let's say that you get a federal refund. Federal refunds are never taxable. How come? Remember, federal taxes you pay are subtracted down here as prepayments, prepaid taxes. And it's not a deduction up here, yeah? You don't get a benefit of reducing your taxable income by the federal taxes you pay, but you reduce the tax liability down here. So when you receive a federal refund, because you never claimed it as a deduction here, it's never going to be taxable in the year you collect that refund. The question is only state income tax refund. Now, how do you know how much state income tax refund you have? Well, you take a look at your, in this case, 2020 state income tax return, or better yet, the government is going to issue out this form called a 1099-G. And here in box number 2, you're going to see the refund amount that the taxpayer had collected. Here is the state government paying out the refund to this taxpayer recipient. Now, even though you do get this form, you still have to determine whether it's taxable or not. So you look at the previous year federal return and see if you deducted state income taxes. You check whether they had claimed itemized deductions. And if not, the refund is tax-free. Let's take a look at the next item here on Schedule 1, and that's alimony. Alimony could be taxable or could be non-taxable. It depends upon when the divorce took place. So let me illustrate that out. Okay, the key year is 2018 and 2019. And the date that the divorce took place. If the divorce took place for 2018 and earlier, the alimony is going to be taxable when you receive it. Or the alimony, if you pay it, is going to be deductible, saving you taxes if you have to pay alimony. But if the divorce took place in 2019 or later, the alimony is non-taxable. The alimony is not deductible, whoever's paying the alimony. Okay, this is right here, December 31st, 2018. So if you got divorced now, you pretty much ignore the alimony income or alimony deduction. It has to have been done, that divorce, prior to 2019. And if so, back here on the Schedule 1, you would write in the alimony income. Here they're even asking you whether that date, that should be before 2019, yeah? And then the person paying the alimony gets to claim an adjustment deduction down here, way down here in line 18. So you would put down the amount being paid over here. Again, it's being paid for divorce prior to 2019. And the date that the divorce took place, again, prior to 2019. And they want to make sure the person receiving it is reporting it as income here, the recipient. So they ask you, what's the Social Security number of the person receiving the alimony? So now you can claim a deduction for that. Our textbook also talks about, besides alimony, something called, related to a divorce, something called child support. It's being paid from one ex-spouse to the other ex-spouse that probably has a custodial rights, yeah? And child support is never it's never taxable. It's never deductible. It's only the alimony Again, prior to 2019, that is taxable or deductible. But when you negotiate a divorce, the amount of child support, maybe you can also negotiate at the same time who is going to claim the child as a dependent, because we've seen that qualifying children can give the taxpayer a tax credit. And more about tax credits in a future chapter. Another thing our textbook talks about regarding a divorce is something called property transfers or property settlements. So when the couple gets divorced, they're going to split up all the property they own. And usually at that point, there is no tax effect when you split up property under a so-called divorce decree or divorce agreement. But let's go through an example here regarding a property transfer or settlement. Yeah. So let's say the couple has two big assets. One is a house. So here's the house that they own to make it a little bit more illustrative. Can you see why I'm not an artist? And let's say the house was purchased a long time ago at a cost of $300,000. But now it's worth 1 million. In fact, this would be a below medium price house here in Hawaii. And the tax term we use is called fair market value. Yeah, has increased in value by 300,000. And let's say that the only other asset this couple has when they get divorced is cash money, maybe in a savings account. Also $1 million. So we're going to split up the assets evenly between the two, the values. So which would you take? Would you take the house that's worth $1 million? Or would you take the cash? Of course, whatever the cash says is what it's worth, right? At $1 million. The house could increase in value, right, over more time, over the future. The $1 million here, you probably would need to invest it to make it increase in value. But right now, it's just worth $1 million. Again, what would you take when you as a property settlement? Well, let's say that you take the house, yeah, and then later on you sell it. That would mean you're gonna have a gain of the difference here between the value and the cost, assuming it doesn't increase higher in value. And usually you pay taxes on gains. We'll learn about an exception when you sell your personal residence. Maybe you can exclude a 250,000 or $500,000 of the gain, but that still will give you a taxable gain here in this situation. Now, if you took the cash instead and spend it, you don't have any gain. In fact, you can buy a house at a cost of $1 million. And when you sell that house, let's say again for $1 million, there would be zero gain. Of course, you want it to increase, right, over time. But if you sell it right away, there's no gain versus the gain over here that's built into the cost of the property. So if you're aware of that, both spouses, maybe they need to sell the house and split up the cash, yeah? And then they'll be able to save maybe up to $500,000 of this gain from taxes. Another big asset maybe some other people have is their retirement accounts. So there's something called a quadro, qualified domestic relation order, a court order that will allocate the retirement accounts among the spouses. And then whoever collects the retirement income later on, typically when they're retired, they may need to pay taxes at that time. So again, if you're giving away your retirement account and maybe keeping cash, which could be tax-free later on, probably you want to take the cash, right? Because this is going to be taxable later on. Again, quadro, qualified domestic relation order. Let's go back to Schedule 1. We've just talked about alimony income. Business income, that's a topic for next semester. In our textbook, that would be chapter 3. So that's the first chapter we'll see next semester. And if you sell business assets, that's reported here on this form. Again, that's a topic for next semester. If you're a landlord collecting rent or something similar called royalties, or if you're a partner in a partnership or a shareholder in a type of business called an S corporation or beneficiary of a trust, these types of entities possibly would allocate income to the owners, and you would have to report it here. And all of these items we'll cover probably next semester. Farm income is similar to business income, except you report income and deductions probably at a different time than other businesses. Here's a common type of income for the past year or so due to the pandemic. Unemployment compensation is usually paid by the states to the residents living in those states. But the federal government, due to the pandemic, has been supplementing the state unemployment with more money. And if you collect unemployment, the government is going to issue out a form, again, 1099G. We saw this previously when we got the state refunds, yeah? But here, back in box one, is the amount of unemployment compensation our taxpayer has received from this state for the year. Hopefully, they've held federal income taxes to pay off this tax on the unemployment. Same thing with state income taxes withheld. Now, for the year 2020, this unemployment compensation up to $10,200 per unemployed taxpayer can be excluded, okay, can be tax free. And the thing is, you don't reduce this box 7, you put the gross amount of unemployment collected during the year, box 7. And then you're instructed to subtract out here and box 8 up to that exclusion amount, maximum of 10,200 for one taxpayer. And you would label it unemployment compensation exclusion, UCE. And together this would just net out to a smaller amount of unemployment to be taxable. Yeah, but you still report the gross amount up here and you show the amount excludable in this line 8 that says other income. So what other types of income goes into this line 8? You can see we have a blank here for the description and we would add up the dollar amounts in line 8. So examples would be prizes or awards you get through contests, to any type of event you receive an award, or possibly gambling winnings, be they legal or illegal. Remember, it's always going to be taxable. But how about if you have gambling losses? Well, you don't reduce your winnings by the losses. You report the gross winnings here on line 8, but you get to deduct any gambling losses you've incurred during the year as an itemized deduction. So remember back here in the 1040 form, most people take the standard deduction, yeah? But if you have gambling losses, you don't reduce your gambling winnings back on Schedule 1. You get to claim them as an itemized deduction, gambling losses for the whole year. But for most people, even with gambling losses here as itemized deduction, the standard deduction is still larger. So in other words, the gambling losses are wasted for tax purposes, and all of the gambling winnings have to be reported here back on Schedule 1. And if it's above a certain limit, typically more than $600, the place that's giving the gambling winnings, like a casino, a racetrack, they're going to issue out a form W2G, G for gambling. Yeah. Let's see, other types of income. Our textbook talks about something called forgiveness of debt. So let me illustrate that. So let's say if some of you have taken previous accounting classes, that drilled in your head something called the accounting equation. The assets you own are equal to the liabilities you owe plus the equity interest of that business. Okay? Everything you own here, everything you owe to other people here, and then the leftover equity you have. Well, if you're insolvent, meaning this equity is negative, in other words, all the assets you own are less than the liabilities. So you end up with a negative amount over here of equity. As long as you're insolvent after they cancel out any liabilities, the forgiveness of debt income is tax free. So typically, if you're bankrupt and they cancel out liabilities, you're probably still going to be negative over here. And that typically means that the liabilities that are forgiven, you don't have to report as income. Let me give you an illustration here. So let's say that you have $5 or $5 million of assets, and you owe a lot of money, $7 million of liabilities. So what's your equity? Well, you're underwater by $2 million. So let's say that bank will cancel some of the amounts you owe your creditors. So we'll bring down the liabilities to six. You now only owe only six. You still get to keep 5 million. They're not going to take anything away over there. They could, yeah, which would change this equation. Tell me, how much equity do you have here? You're still underwater. You're still insolvent by 1 million. So the cancellation of debt here is not going to be reportable as income. But let's say that they reduce the liabilities by 4,000 down now to 3,000. Let's say your assets are still 5. Tell me, what's your equity here? Now you're back up to $2 million positive. And if they reduced your liability, canceled it by 4, that means 2 of the $4 million cancellation is taxable. Okay? Because now you're solvent. Here you were insolvent, yes? So the cancellation of debt was not taxable. Okay, so this is the topic that was covered, I believe, near the end of our chapter. Let's do one more miscellaneous income that may apply to you. So let's go back to the 1040 form. And we're familiar with this line 1, wage or salary income, even tip income that's reported to the taxpayer on a W-2 form. So maybe you, as a student, have a campus job. So probably you'll get a W-2 form after the year's over. But how about if you get a scholarship or a grant? Well, the general rule is that the scholarship and grant is tax-free if you use the money for qualifying education costs. That includes tuition, textbooks, supplies, maybe even if you buy a computer that's primarily used for your classes, like you're doing right now, right? You can't get along doing an online class without access to a computer. So as long as that scholarship and grant is used for qualifying education costs, that scholarship and grant is tax-free. Now, if you use your scholarship and grants for other types of costs, be it even related to school like room and board, travel to school, that type of scholarship used for non-qualifying costs is taxable. And what you got to do is you got to report it here in line 1, possibly with the letter scholarship, yeah? SCH. And the reason why you want to put it here in line 1 and not back on schedule number 1, because if you remember in the previous chapter, we talked about the standard deduction. And if you're claimed as a dependent on somebody else's return, and that's true for most students that don't have any income except maybe their scholarship, the standard deduction could be quite small as 1,100. But if you have earned income, that standard deduction could increase. Remember, earned income is like your wage or salary. Or in this case now, scholarship income is considered to be earned income. And then maybe you can qualify for a larger standard deduction to offset the scholarship income and then maybe pay no taxes. Okay, so scholarship income, you want to report it here. Now, how do you figure out all of this? Yeah, well, you can probably go online to your college, university account and download this Form 1098T. And here would be the amount of scholarships and grants that was processed by the school. If the scholarship or grant was paid directly to the student, the college here would not know about that. Yeah, it's only if the scholarship or grant was paid first to the college to offset any costs, and then maybe any excess scholarship would then be paid to the student. Or if the student got the scholarship directly, the college would not know about that. And of course, here's the biggest cost that the scholarship would be used for, yeah? This tuition. And we'll learn about a education credit if the total cost is larger than the scholarship to get a credit. But if the scholarship is larger than the tuition, if the scholarship is larger than the supplies or textbooks, or in our case, the access code to Cengage, then the excess scholarship could be taxable. Um, I think that's it. So let's stop here. Make sure you do your homework assignments and the tax return project and quiz for the chapter. Everything should be available for chapter 2. Most of it is available now. The rest will be available sometime early next week. Okay? Contact me, email me if you have any questions. I'll talk to you later.